Hello and welcome to the fifth edition of Bazaar ki Baat. Last month, Indian equity markets were largely flat, but smaller companies continue to lag the larger peers. We saw a lot of volatility in the global equity markets, largely on the back of the bank crisis. But despite all the chaos, we saw the US indices ending positive, mostly because of recovery in the technology stocks. Kshitish, happy to bring you in here. What's your view on the overall market?
Yeah, so if we, I would like to say that Nifty and Sensex if we only talk about March, they are flat. But even if we take the FY23 as overall, and they were flat in Nifty and Sensex in FY23 also. It is the small cap index where we have seen the deepest cuts for FY23 and both in March. So clearly we are seeing there is stress in the smaller companies which are bearing the brunt of the global uncertainty. Largely my analysis is that they are dependent on exports. uh, I recently read that there is a almost about 60% of the downgrades in the second half of the fiscal 2023 in CRISIL rating universe were in the sub-investment grade category, which are largely compromised of MSMEs. So MSMEs are being hit on both the sides. First of all, they are being hit on the volatile commodity prices, and also they are the ones which drive the export oriented sectors, so which is facing headwinds due to the global slowdown. So these are both on both the sides is they are being crushed. So that is the reason why we are seeing such a sharp fall in small cap as against to the peers. So the overall picture is, though the Nifty and Sensex are flat, the broader markets have corrected. So which we are seeing in most of our portfolios, we would see that pain. Further, when we see what could be the reasons of these corrections, is that largely what first of all the global markets are the key determinant in that, is that, and even in global markets when we talk about why there is such a large correction or slowdown, we would probably have to blame the central banks who have been hiking very sharply. Fed has hiked almost 475 basis points in the last 12 months. So, and as we all know, interest rates are like gravity for equity markets. Most of the value for a stock comes from the terminal value, not from the growth, not from the current equity earnings. It comes from the terminal value, which gets hugely impacted by the interest rate rise or fall. So any rise in interest rate impacts the equity valuations very sharply. Further, what has happened is that the Fed has also tightened the liquidity. They have stopped the QE and have been reducing it for a while now. So what this has led is there is a liquidity crunch in the overall global market, and which caused the FPIs to pull out a lot of money from India. We saw almost around 41,000 crores being pulled out in FY23 from India. This in itself may not be a large number, but on top of the 1,22,000 crore we saw in FY22, in these becomes a huge number. So overall, in the last 2 years, we've seen an outflow of around 1.6 to 1.7 lakh crore from FPI from the Indian equity markets. Finally, what has happened is that the we always feared that the Fed is swinging the X too hard. So now what has happened is that the this rate hike, which has been done so sharply, has impacted the global banking system. And few of the banks, we saw the sudden collapse of SPB and Signature Bank, which was followed by a forced merger of Credit Suisse and UBS. So there was a large uncertainty due to these global events, which prevailed in the month of March, and which created an overhang for the Indian markets also. Post SPB debacle now, what has happened is the though it's a bad news, but what happens is that there's a very large bad news. The market starts expecting that the central banks will come in and play a positive role. So there has been a feeling among markets that there will be a rate cuts or lower bond yields over time, and which should again lead the recovery in risk assets. Risk assets are like equities or global equities, EM equities. So there should be a recovery. Domestically, we have been doing very well. There may be sector specific issues, but overall, we remain the fastest growing large market or large country. And but on the other hand, inflation has been high, so which has been impacting the margins of companies. And though if we talk about growth slowdown in FY24. We have recently seen there are news. World Bank has cut its projection, and other, I think IMF has also cut its projection. But overall, there may be a slowdown in growth for economy, but the earning growth expectation is still around 15 to 20%, which is largely due to the expectation that as the fall in commodity prices, there should be a fall in commodity prices and margins should normalize. So, and I would probably like to add here that the recent correction in equity valuation for Indian markets have actually made the valuations very attractive. And though they may be still higher than the long-term averages, but long-term averages may not hold now. The composition of that index has changed dramatically over the years, and we will see this later in detail. But I would say that this may be a good time for investors to enter in the market from a 3 to 5 year perspective, because I would say there are structural positive for India. We will
Right.
be, but I would like to still give a caveat that we are going to enter the election period. We'll have general elections in 2024. So any uncertainty on the political front may lead to short-term underperformance. But still, I would say for a 3 to 5 year period, this is a good time to enter.
Yeah. So of course, I mean, like we started, there has been a divergence in Indian equity markets and global equity markets in the way they've performed. Even when we look at the sectoral breakdown, we see that it was a little bit of a mixed bag. I mean, we see that capital goods has been a consistent outperformer throughout the year, whereas IT has continued to be in stress. And even for factor indices, momentum, specifically for momentum, it has been a good month after 2 to 3 months of stress. So what is your view on why do we see a divergence in the sectoral performance within the Indian markets?
So why is actually not surprising if the equity market overall acts as a flat, then some sectors are supposed to do well and some factors are supposed to underperform. But the metals and commodities, if we see, they have been the star performers, largely due to the factor that it is a play on the hopes of China market opening, which played out. And also another star performers were oil and gas, pharma, housing, and FMCG, which you can see from the table. Automobiles and IT were the worst hit, largely due to the fact that they are the ones which are dependent on global linkages, right? They are expected to be the worst hit in any global crisis. And for IT, the global banking crisis is also a big challenge because they have a large share of their revenue coming from the global banks. So that has been the reason what happened overall in March 2023. And for FY23 as a whole, if we see, again, defense as a sector has been the big story on the back of solid order flows. There has been so much talk about Atmanirbhar policy in defense, and which has led to the recovery in many of the defense stocks. PSU banks have started doing well, largely on the account of sharp recovery in the credit offtake, and which has led to loan yields rising faster than the cost of deposits. Another big sectoral performance, which we can see in for FY23, comes from FMCG and autos, which are largely defensive plays, right? We will normally people will go to FMCG and auto when the market is not doing so well. And laggards, as we have already discussed, the IT and digital lead the way there, largely due to the fact that the market believes that they would be the worst impacted in case of a global slowdown. And the large tech spending may not happen as was earlier expected.
Right.
Yeah.
So we're talking about sectors, and you just mentioned that Nifty 50 has seen metamorphosis over the years. And what do you think? What's your view on how the sector allocations have changed within the Nifty 50 index?
Yeah, so over the year, the sectoral, if we see the chart, so it gives us a very interesting perspective. Over the years, the sectoral representation in Nifty 50 has undergone a sea change, right? This is largely in line with the changes in the underlying economy. And the index, if we go back in probably 1995 when this index was introduced, it comprises largely of heavyweight companies, and the index was defined in terms of the full market capitalization. However, in June 2009, it shifted to float adjusted market capitalization methodology from the complete market capitalization weighted index. So which lead to a sharp change, right? So
Okay. So what does this change of methodology mean? I mean, can you just break this down in layman terms for people to understand?
yeah, so basically, float adjusted market, see, full market capitalization weighted is simple. Whatever is the market capitalization weighted by that, right? While float adjusted market capitalization methodology is that you derive it by multiplying the share price by the number of shares that are publicly owned, basically unrestricted and available in the open market. So which is basically the removing the promoter shareholding. So earlier the companies which had smaller float were their part of the larger part, but had a larger, but it's a larger company, were part of the index, but now the index is more dependent on companies which have more public money being invested. And due to this fundamental change in June 2009, there were big winners and losers. So there was drastic change in 2009. A few noteworthy changes which I saw was that which I read and also saw during my analysis that the NTPC and ONGC, which were together lost almost 10 percentage point weight in the Nifty at that time. And TCS also was, I think, around 2.5%. It lost to 1.5%. So there were big changes which happened due to this change in methodology, which is simply you index give higher weight to companies which have more public money being invested instead of something
Right.
which is a larger company but have
So Shitish,
listed. Yeah.
so this change in the composition of index, what were the implications on the investors because of this?
Yeah, so first let's see what are the changes, right? In the sense, so the biggest change if we see is that the financials became a large part of the index. We can see that it is almost at 37% currently, the BFSI sector. Largely, I would say private banks and NBFC is the reason. They have gained a lot of share above in as compared to PSU banks, which were the PSU banks were actually at a point in 2022, 2002. PSU bank share was higher in index, and now private bank have become such a heavy have the highest weight in Nifty 50 as a whole. So which the reasons are many, like better earning performance and stuff like that. We can talk about it. This is a, I would say, a multi-year trend which has happened, and this trend is going to continue as in more and more financialization happen. While if we see the oil and gas sector has been very volatile, if we see the charts, we saw a sharp rise when ONGC was included, and then it almost pushed the share up to 25% as part of as the weight of the index. But since then, it has come down as the sector has not performed. So it is in line with the volatility in the, I would say, earnings of the sector. And the decline in auto sector earnings and the uncertainty around the future of EV has also led to the fall in auto sector prices, and the re-rating of the sector and the weight has also come down. If you see metals, probably metals again has bounced off from the lows. Probably I think it was 1% in 2015, calendar year 2015, but it has come down. Come up from there, but it's still far lower than the peak of around 9.7% in 2003. So it is the so the so if you see it kind of captures the volatility in certain sectors, while some of the sectors which have done very well have performed well in the index, and while the sectors which have remained very I would say consistent, like for example IT, FMCG, consumer companies, they have been relatively stable. So if one fun factoid is that only 12 companies are there in the Nifty 50, which has since inception. Notably, few of them which I can remember are Reliance and ITC, HUL, and maybe Tata, a few Tata companies. There were companies now the change which you have talked about, like SDFC and SDFC Bank and TCS have consistently became more prominent, while companies like large companies like the oil sector ones, the ONGC, NTPC, they have lost prominence. So this has been the overall movement. And one thing which I would like to point out is that though we talk about Nifty 50 as a 50 stock index, but the composition is heavily skewed. There are almost 26 companies which have less than a percent of weightage in the index. So more than 50% of the index is from only half of the companies. So
Interesting.
yeah, so yeah,
So basically, it's safe to say that the winners get to stay and the losers
yeah,
kind of
yeah,
get
yeah, yeah,
weighted
yeah,
out in the
yeah, yeah,
market.
yeah, yeah,
Oh,
yeah.
thank you.
So
Thank you so
as
much, Shrit. Yeah, continue.
So yeah, no, no, I would probably like to just put in a disclaimer here that the implications here is that we cannot now just rely on the historical P levels for any asset allocation model in Nifty, right? All the recent additions in the index have come from sectors which generally have higher multiples, like for example, FMCGs or even let's say new age companies if they get added, or even banks, for example. In case of now that the weightage of the banks is almost more than one third of the index, the PE ratio becomes meaningless, right? Because for PE ratio is not a relevant index to measure a bank valuation. P by B is probably a better index. So it's important for us to recognize that the historical PE measure may not be a good comparative point for a long-term average may not be a comparative point for comparative valuation metrics for Nifty 50. Maybe probably 5 year, 10 year average would be the better index. So that we have to keep in mind. And while comparing valuations of the current Nifty 50. Yeah, yeah,
All right.
right,
Okay.
yeah.
Thank you.
Uh,
Thank you so much for your insights, Kshitij. We have recently, come across a change in the taxation implication for debt funds, including international funds and gold funds. Vikas, do you want to throw some light on what were the changes that were brought in?
Hi, Shruti. This was actually a surprise for a lot of investors because there was no discussion around this in the budget, and suddenly, nowhere, one evening, there was a clarification that there are some changes in the taxation for debt mutual funds. We have been talking about debt mutual funds over the last 2, 3 months that this is one of the attractive asset classes because of the various products which have come in the market, which has reduced investor risk, and it was very tax efficient. So now there's one bad news that the tax advantage, which was one of the very, very good means for investors to save tax, goes away. So there's definitely one bad news, but we have to take things as it comes because this is beyond our control. So what has happened is that like pure debt funds where the predominant investment was debt and uh, there was no equity involved. So for those, the FM thinks that the risk is quite low and they behave like a normal like FD, which I don't agree because there is only a particular class of debt fund which has lower risk, but a lot of debt funds are taking risk. So with this change, what happens is that any asset class which has less than 35% equity is now being taxed at marginal tax rate. Also, the brunt is like faced by other funds also which were under the same category, but we can't help it. So now what happens is another asset class, which is international funds, gold ETF, gold funds, all those asset classes where they do not invest more than 35% in Indian domestic equities also will be taxed at marginal tax rate. So now what happens is that with this, we need to seriously look into all these kind of investment instruments in terms of what is their post-tax return. So this is one thing which now investors have to check whether like this asset class in terms of post-tax also makes sense for them. What we'll see is that there would be some like more asset classes or different funds which should come in where they'll have 35% of the equity like exposure to Indian equities and the rest would be in the other asset class. So we'll have to wait for that. Other than that, what is the way forward for debt fund investors is something I think which is more relevant for investors because what has happened is beyond our control. What we should think is that how does the investing framework looks after 1/4/2023 because this is what will help us in managing our finances going forward. What I feel is for investors still, if suppose they were using debt funds to do systematic transfer plan that does not change because in that they have the convenience of parking the fund in a debt fund and then systematically investing in equity rather than getting it debited through bank, which is more cumbersome and requires some decision making. So that does not change for that set of investors because systematic transfer plan anyways was being charged at the marginal tax rate. This will happen post the new tax changes as well. What happens is that a lot of investors keep money in debt funds because they don't know when they will need the money. In fixed deposit, what happens is that since it's a term deposit, you have to specify a particular term. And if say suppose before that term, if you redeem your fixed deposit, a lot of banks charge a penal interest of 1% as premature deposit. And what happens is that you will also receive the interest rate for that particular period for which your money remained with the bank rather than the contracted rate. So this is another thing that a lot of fixed deposit investors need to keep in mind that if say suppose you are not certain about when will you need the money, in that case, debt funds still make better sense if you are investing for say more than 3 months, 6 months, because you will like get that option of liquidating it anytime without any penalty in terms of the rate that you have contracted and a penal interest that is being charged. Another important thing with the fixed deposit versus debt fund is that in debt fund, you can defer your taxes. So now what I think is that a lot of investors do not appreciate this fact about deferred taxes. But this is again a very, very important aspect in personal finance that if you can defer your taxes, you can enjoy compounding on the amount which would rather have been paid as taxes. So that compounding on the taxes that you would have paid also adds up a lot when you stay invested for the long term. So this is again a topic which needs like specific examples to be discussed. So we'll cover this in our next session so that we can complete, like we can discuss with various scenarios and various time frames, what is the actual advantage, what happens. Another advice for investors would be if you're investing in debt funds, you should try now to ensure that you are investing in two debt funds. Now, this is again one thing which will help you manage your taxes in a better and planned manner because the taxation of debt mutual fund is that it is taxed on a FIFO method but on folio wise. So if you have two folios and if you're not touching your other folio, that other folio can compound and you can defer your taxes. One folio you can use for your short-term parking or for any kind of redemption requirement. So even if say suppose for STPs, one folio is there, your long-term debt allocation now should be shifted to a different folio so that it is redeemed only when you have no other alternative. this can definitely help a lot of investors manage their taxes better with debt funds. Another thing is that now, since you are being charged for short-term capital gains on your debt funds, if you have some short-term capital losses from your other investments, those you can plan uh, way ahead, and you can actually save a lot of taxes with that also. So suppose if you can plan your short-term capital losses in your assets, you can set off them against your long-term short-term capital gains. Then the other asset class, if you are booking it at short-term capital loss, and if then you stay for more than 1 year, 3 year, whatever is the regulation, then you can make long-term capital gains over there and you can save taxes. And again, deferred taxes again will come into the picture. So I think these are 4-5 things which still remains very relevant. If you are like managing your finances, if you checkbox on these elements, it will still add a lot of value. So the case for debt funds is not over. But yeah, one of the important aspect which was making debt funds investment a no-brainer, that has definitely been removed by the tax authorities. But still, debt funds should still have a place in the investor portfolio, and they have to be careful about all these things. So this is, I think, from my end. Next week we'll definitely discuss about deferred taxes.
Right. So, yeah, so I think the no-brainer aspect of debt funds has been taken away. But as Vikas said, there are a few use cases in which debt funds still make sense. Thank you so much and stay tuned for our next issue.